Ever wondered how to tell if a market rally is truly healthy or just being driven by a handful of superstar stocks? Today, I'm breaking down a powerful tool that top investors use, relative strength. It's simple, but it can totally change the way you see the market. So, what exactly is relative strength? In plain English, it's a way to compare the performance of two assets. I just take the price of one and divide it by the price of another. When I track this over time, I get a line on a chart, the relative strength line. Here's how I read it. If the line is rising, the first asset is outperforming. If it's falling, the second asset is winning. And if it's moving sideways, both are moving about the same. But let's get practical. How do I use this to spot a real broad market rally? One of my favorite tricks is comparing the regular market cap weighted S&P 500, where giants like Apple and Microsoft hold the most sway, to the equal weighted S&P 500, which treats every stock the same, no matter its size. When I divide the market cap S&P by the equal weight S&P, I get a ratio that tells me who's really driving the market. If that line shoots up, it means those mega cap leaders, the Magnificent Seven, are dragging the whole market higher by themselves. That's what I call a narrow rally. But if the line flattens out or drops, it means more and more stocks are joining the party. That's a broad, healthy rally, exactly what long-term investors want to see. This isn't just theory. Back in the dot-com boom, this ratio spiked as tech titans dominated. Then, in the 2000s, it fell as more stocks caught up and the rally broadened. Now, after the AI-driven surge of the past few years, we're watching the same pattern play out. So what should I watch for in 2026? If the megacaps just tread water and the rest of the S&P 500 starts to catch up, you'll see that ratio flatten or drop. That's my signal. The rally's getting healthier and opportunity is spreading. Where am I looking for winners? Cyclical sectors like industrials, retail, and banks, companies that thrive as the economy grows. I can also use relative strength to compare risk on sectors like consumer discretionary versus defensive ones like staples, or large caps versus small caps, even gold versus silver. Bottom line, relative strength isn't just for charts. It's for spotting where the action really is and finding the next big winners before the crowd. So next time you hear about a market rally, dig deeper. Run the numbers. Use relative strength and unlock the secrets behind the headlines. If you found this useful, hit that like button and subscribe for more straight-to-the-point investing advice.